Hello friends, namaskar and welcome all of you to my channel. I hope all of you are doing great in your business, in your own duty. Now let's discuss about the two important concepts, that is the one is working capital and next one is the operating cycle. Now the question is about how do we analyze these two terms. Even though as a financial analyst, even as a businessman as well, we we are more looking for our overall working capital positions and even the operating cycle. Now based on this background, let's move to the discussion on its concept. Now first of all, as a entrepreneur, you know that you don't want to hold many of your assets appearing in your balance sheets. I mean to say that you don't want to park more your fund in the current assets because you are expecting that your return on investment while investing in the current asset would be lower as compared to investing in the fixed assets. You are taking the more risks. But condition is that you would be holding the more fixed asset which generate the goods and services and ultimately which induce your profit. And that is why it is we say that is when you read the literature in this regards, then as a entrepreneur you hate to hold the current asset more as compared to fixed asset. That is the basic understanding. And next one is that business is friends, that is the continuous process and every cycle of the operation generate the current assets. Like current asset component could be like your inventory, receivable, including cash. You don't want to hold the more current assets. I already explained this one. And next one is that which could be used for immediate financing requirement. We can say that to finance your current asset, we could use the current liabilities, and that will be explained better by the concept of working capital itself concept. Now let's move to the concept of that is the what about we mean that's current uh, assets and the current liabilities. And before that, you look at the concept of working capital, friends. That is the as for this Goodman is 1948. So long history. We define working capital as a excess of current assets over the current liabilities. Yeah, you can say that that is the current asset is greater than current liabilities. In that case, you would have a working capital position would be positive. And remember, friends, in that case, your current ratio would be better positions. If your current asset is higher than current liabilities, that means that you could take the responsibilities of bearing the current liabilities. That means your short term, you can say that solvency position is good. Okay, that means current ratio, you could use the quick ratio 2 to measure your overall short term solvency position. Now the question is, friends, like your from the accountant's point of view, working capital equals to that's a net working capital. Simply net working capital is current asset minus current liabilities, which is based on the going concern. Okay, while as for finance manager, the proper management of the current asset and the current liabilities, yeah, you can say that management of the working capital required for ensuring interdynamic stability among them and interdynamic relationship between them. One thing I would like to explain here, friends, that is if you hold more liquidity for your business, then in short run probably you would have a positive relationship between liquidity and profitability. But at the same time, in the long run, when you do the research in this area, probably you would have a inverse relationship between liquidity and profitability. That is the basic reason I started the discussion from the as a businessman, we don't want to park more fund in the current assets. We try to take the more risks, and that is the basic reason. Based on your proper strategic analysis, you would be investing more in fixed assets, for example, property, plant, and equipment. But that is the productive investment. The condition is that that must generate the goods and services and ultimately enhance your profitability positions. And that is why it leads to the concept of two concepts here that you need to understand. One is the called gross concept, Under gross concept, simply we say that is the total current assets, while net working cap, sometimes we say that gross working capital, which could be also called as a just gross working capital, or you can say that gross current assets. Okay, now let's move to the next concept, that is operating cycle of the business. Now remember friends, look at this figure. I hope you could understand this one. Operating cycle is that, for example, when we have a cash, you'd purchase the goods and credit. If you don't have cash, we have to purchase the goods on credit. That means you would have two options. I mean to say that one is the cash purchase, either, yeah. Next one is that credit purchase. Now, basically, we purchase the raw materials, for example, so that we could convert the, yeah, produce the goods as per the demand of the customer, and ultimately we have to sell it. Again, we sell the goods, either that is the cash sales or the credit sales. When we have a credit sales, then again we would be collecting the cash from the customer, and ultimately this cycle will be continued like this. So it's a wonderful concept in, again, that is even we discuss in financial accounting, even in the financial management, yeah, you can say that corporate finance. Then that is all about gross operating cycle. You remember we have a two component here. One is called inventory conversion period plus receivable collection period, which is also known as days sales outstanding, yeah, average collection period. And basically ICP is simply how long does it take for a company to convert the inventory into sales. Remember, we try to meet the customer demand on the fast than that of our competitors. So our target is to shorter the inventory conversion period, okay, based on your proper inventory management. Now the question is about how we could find the inventory conversion period. So you can simply say that number of days in a years, like 365 days divided by inventory turnover ratio. If this is not given, then you could use this equation, cost of goods sold divided by average inventory, that's opening inventory plus closing inventory. While cost of goods sold here is, that is simply if you exclude the gross profit from the net sales, that will provide the like cost of goods sold. Okay, now remember, higher the inventory turnover ratio means that you would have a strong sales, while a lower one shows the weak sales position. Okay, this way you could manage your overall inventory properly, so that you could produce the goods and services for your customer faster than that of your competitor, and accordingly you could have a, you could enjoy your strategic advantages, yeah, you can say that competitive advantages over your competitors. Now what about the second component, that is receivable collection period, which is also known as days sales outstanding. When we have a credit sales, how long it will take to collect the receivable from the customers, and for which we have to follow the proper credit policy. Okay, so that the chances of uncollectible account will be lower, yeah, bad debt. So proper credit analysis is required when we deal with the credit sales. So this way, number of days in a year divided by receivable turnover ratio, this is simply net sales by average receivable, which simply reflect how efficiently a company convert its receivable into cash. That is the important point, is that receivable management in finance we say that, and in financial accounting we say that accounting for receivable, like that. Now second concept is that net operating cycle. Net operating cycle, which is also known as cash conversion cycle, friends. We have a three component under the NOC, net operating cycle. One is ICP, inventory conversion period. Next one is, friends, that is the receivable collection period. And next third component is that is the payable deferral period. As a businessman, friends, we have to, let's say the ICP should be shorter, receivable collection period should be fast, that means it should be shorter, while payable deferral period, we should not stress the payable, so that your reputation of the company would be affected. But generally what happen, the business person, they try to stress the payable. But remember, stretching payable is not the good signal for our company. We have to make the payment on the time, so that supplier would again supply the goods on the credit in coming futures. Okay, so the length of the time a company takes to pay its suppliers creditors for goods and services after the purchase is made on the credit. That is the point here. This is the purchased raw materials on the credit. Then our job is to, we have to pay the dues on time. It's good. If you stress the payable, then probably in coming days that supplier may not supply the goods as per your demand even. Okay, but if this is not given, by the way friends, that is average account payable divided by cost of goods sold into number of days in a year, that is a 365 friends. Okay friends, basically today I just discussed about the concept of working capital. Yeah, operating cycle, you could analyze the annual report of the company, then accordingly you could take well informed decision friends. Okay, I believe that whatever I discussed today, it would enrich the concept of two term, that is as I discussed, that is the one is the that is a working capital and the operating cycle itself friends. Okay, thank you all of you friends watching this video. If you really like this content, please like, subscribe, and also share my channel, that is the Finance Guru Pawan Kumar Jha. Thank you all of you for watching this video. Please take care all of you. Thank you.